Hello and good morning, listeners. Welcome back to Almus Market Mornings with Shikhar Garg, and we head into the final trading day of the week. The ritual suggests we say TGIF, and looking at the kind of update, it is more so imperative. Yesterday was a day with two opposite sets of data being released for the US economy. One side, the numbers suggested that the US economy created far more jobs than expected, and the job market continues to stay hot. While the weekly jobless claims suggest otherwise, the jobless claims jumped to a 20-month high. Now, this is the kind of confusion that we've been seeing, and probably one of the things that FOMC will have to address when it comes to their policy. But all this confusion has also led to the currencies weakening and dollar strengthening against the uh, general index or the currency comparisons. JK, so I'd like your decades of experience. Now, as you just some time back mentioned, you've moved from Stone Age to the current age, and your wealth of experience of 46 years. What do you see in the markets right now, and how should we be looking at things?
Yes, I would say it was a very tumultuous day in the markets yesterday, and the signs were there right in the Asian time when there was a sea of red on the stocks, starting from the New Zealand stock market, and then Japan, and well into the European time. And in fact, Europe had a big fall in their markets, and it was also preceded by last few days of rise in the yields in the US, and then leading other market yields also to rise, even as data were not so bullish from Europe and US. So gave a sense of market was preparing for some sort of turmoil in the bond market, which became more visible as we moved later into the day. And the key 2-year yield in the US hit a new high at 5.12, last seen in 2008, and then also the 10-year clearly breaking the 4% mark, and these were big moves. And now this is also accompanied by, as you said, very strong jobs market data, which Fed considers very crucial in its policy making, apart from the PCE core inflation. Although the job data, on the face of it, ADP private roles rising almost double from previous month, and then the uh, job cuts being almost 49% lower than the previous month. But they actually mask some details, because although the job cuts might have been lower, actually we have had a 200 plus point increase, 200% plus increase in the overall job cuts compared to 2022. Also, if you look at the jobs, overall job creation itself, there is one data called the average weekly hours. So the average weekly hours has been falling. The average weekly hours is the total number of hours worked by all the workers divided by the total number of workers. So the number of people employed are more, but each of them is working for less hours. So these are some, if you drill down the data, these are some things which are not so great. But yes, ADP coming at that number is really very big, and possibly non-farm payroll, which is actually expected to be in around 2,25,000 versus 3,39,000 last month, might be a big number as well. But if you look at the reaction in the dollar, it's not really looking very bullish compared to the rise in the yields or in the strong economic data that we have been presented with yesterday. In fact, the ISM services also, which came higher than expected at 53 plus, and in which also we saw the employment index rising to 53.1 from 49.2. The good news there, of course, was on the inflation, where the prices paid were lower, and new orders were much higher because of the good export performance. So overall good number, but DXY actually slipped 0.15% during the day. And look at yen, that was not weakening, ignoring further widening of rate differential with this. There seems to be many other factors working in favor of yen, which we should not ignore. Yen traders may be looking at a much larger risk-off situation to emerge in the coming days. Then Nikkei also reported an interview with Deputy Governor Uchida. He said the balanced approach should be taken for tweaking the yield control policy and fueling speculation that policy tweak might be forthcoming in July. And Japan's pay grew at the fastest pace in 28 years in May, as per the government data published yesterday. So all of this might be actually seeing the yen strengthen despite the rise in yields. GBP was, of course, best performer because, again, some investment bankers are looking at the official rate going up to 7%. It does look an exaggeration, but looking at their inflation, that cannot be, ruled out. But on the other side, we had the Latin American currencies, which lost well over 1%, because this was again a case of profit taking. Now, it's only to see whether this is a one-off profit taking or it becomes a trend that will be decided by the upcoming data from the US, and also the belief on whether they go for just one hike in July or two more hikes. So that will be very crucial as far as the markets are concerned. 2-year yields have definitely slipped from their highs, but still above 5% mark. So it's not really, it is a nervous market out there, because any break sustained above 5.10 and 2-year will be a lot more tension for the market. Then come to our own rupee, it has not lost any of the drama. The weakness was very, very telling compared to what it was 3 days back. 1% move higher in the USD INR. Although the move has got exaggerated, because the market was ill prepared for the move. And just a few days back, everyone was looking for rupee to extend its gain to 81, and well justified by the strong flows and also the fundamentals. But subsequent actions from PSU banks triggering stop losses for traders and unhedged importers has seen it rise phenomenally. I mean, we have been used to very narrow range. We have talked about ranges being in 8 paisa, 10 paisa for several days. And then also we were talking about the wallets being very low, and it was always on the cards to have a big move. But then the pace at which the big move has happened probably caught many people on the wrong foot. And that's the reason why we have seen exaggerated rise to 80 to 80. That said, I think looking at central bank's stated policy of keeping exchange rate stable, I would expect them to be actively intervening around 80 to 80 levels. And eventually a correction in either price or time is very likely. There is no change in the strong fundamental situation of the Indian economy, and would not justify more weakness unless it is driven by very large risk deterioration in the global markets. Yes, I think we should have a very active Friday. It's too early to say TGIF. Thank you.
Okay, JK, I'd to some extent, yes, I have to agree with the kind of updates that we are seeing. It's a bit too early, but all said and done, it's quite interesting. I mean, I really like the point that you mentioned that the average weekly hours are falling. Now, this is an interesting insight, because even though the job numbers are being created, the working hours are reducing. And how does this actually influence the hourly earnings and eventually the consumer spending and the productivity is an interesting thing to watch out for, because that will eventually lead to the kind of growth the economy is seeing. Overall, as JK mentioned, the nervous market sentiments are out there, and everyone's patiently waiting out there for the FOMC to see what sort of an action are they going about. Because even the 2-year yields, as you mentioned, JK, it hit the 5.12 levels, which was last seen in 2008. And with all the sea of red in the global markets, it is although more important to see where things go about in the coming few days. And coming on to the domestic markets, strong flows and the extremely strong fundamentals, even though we see both the things for Indian markets, it was quite surprising. And rather, the markets were less prepared for the kind of move in USD INR we've seen in the last few days. And it's, as JK mentioned, a bit exaggerated. And we've already seen the central bank come in around 82, 80, 82, 90 levels several times. So let's see how things go about this time. That's it for today, folks. There's no change in the Indian macro situation, and similar has been a report shared by the Finance Ministry Department on the economic assessment for the Indian economy. We'll go and dig deeper into that and bring you further more updates. Till then, that's it for today, folks. We shall come back again Monday with another round of updates. Thank you.